You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it's time once again for Options Playbook Radio, the program here on the old network where we break down the world of options, sometimes scary, sometimes impenetrable, sometimes just opaque and arcane, into simple, easily digestible and understandable offensive and defensive plays that you can utilize in your own portfolio. My name is Mark Longo from theoptionsinsider.com. As well as, of course, from the aforementioned network. And if you're saying to yourself, wait a minute, hold the phone, this is the wrong guy, where's that other guy on this show? Allow me to introduce that other guy, also known as the options guy, Mr. Brian Overby, the senior options analyst over there at Ally Invest. Brian, welcome back to your own show, sir.
Well, it's great to be back, Mark, and it's always wonderful whenever you and I can get together. I don't think we do this enough where we actually get to answer some of the listener questions, and I actually think the timing is perfect because it's just about time to start picking your fantasy football leagues. So I think we should huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the huddle. Like the man said, this is the portion of the show where you guys take the reins, questions, comments, insights, snide remarks, all that fun stuff. We welcome most of it, at least here on the old huddle. Let's see how many we can get to on the show today. Let's kick things off, Brian. Sometimes we like to turn the tables on our audience. We ask them every week a different question of the week, and recently, obviously, we're in the middle of the earnings season. People listening to this show will know because you've been breaking down a lot of interesting earnings trades. So we asked our audience kind of which names do they feel were going to dominate their earnings trading, and we gave them 4 choices. This was going into the end of last week, so we just finished it up. And the big names popping off then, of course, were coming in were, of course, Apple, Tesla, and we gave them some other fun names, GoPro and CBOE for our options-minded audience. CBOE, of course, the house of VIX and SPX and all that fun stuff. And go figure, Brian, Apple won with 47% of the vote. Tesla coming in second with 37%. CBOE getting 10. GoPro, no love for GoPro, kind of 6%. But I'm curious, Brian, this is interesting, too. I'd love to hear your thoughts on that in general. But B, also, you guys at Ally, obviously this is a busy time for you guys over there. What's lighting up the tape over there at Ally during earnings season this year?
Well, as usual, I mean, honestly, 70% to maybe even 80%, I don't have the exact number of our volume is basically in the FANG stocks. So like, especially if we throw in the outliers like Microsoft and a few of those other stocks that are in the FANG area, that usually does 70 or 80% of our volume. But when, right now, today we have booking.com that's going to come out, and that really drives orders beforehand. One of the big things is about the fangs is that there's so much going on and it's all in the same week, and it's kind of hard to keep up with that. But Tesla has been in the news, and that was a great one to add to your list. Thinking about going private with the company. There's whispers that Elon Musk might take the company private. And that has really driven a lot of trading this week for Ally Invest customers.
Yeah, how crazy was that? He's going to muster up, $72 billion in the private financing market? Just as you do, you go out, you buy a cup of coffee, you raise 70 plus billion. It'd be the largest, LBO in history by like several orders of magnitude, if that were indeed to happen. I do believe that. I think I saw a tweet coming in right as you started the show that the SEC is actually looking into that. Maybe that's a little bit of too much aggressive pumping. We shall see. But that wouldn't be the first time the Tesla folks have talked up their stock, and that wouldn't be the last time probably either. We could talk Tesla for the whole rest of the show, but we got other questions coming in here. Let me see. Here's a fun one. Kind of talking the opposite side of the spectrum. We were just talking about Tesla, which is threatening 400 as we're speaking, getting pretty close to it. Let's see. We got the other side of the spectrum completely, Brian. This question comes from Imhad1. They say, is HMNY, this is, if you're not familiar with it, listeners, this is Helios and Matheson. This is the parent company of a name you may be more familiar with, MoviePass. And as you know, they've been having some problems lately. Imhad1 asks, is HMNY now the most option-like stock ever? Back to 8 cents after reverse splitting up to $14. Crazy. Who would buy an option on this thing? Well, not many people. I just pulled it up. It's trading a whopping 7 cents now, so it's dropped even more since you wrote in here to the show. One of the reasons they did reverse split, you're right, about 250 to 1, which is absurd. One of the reasons they did that reverse split was to try to avoid being delisted. I think now they're on NASDAQ, and I think the rules on NASDAQ, if you're below $1 for 30 days, you're gone. So they wanted to try to avoid that, and as a result, when these are this cheap, you're right. There's not a lot of use case or even really options being traded. It says here I'm still showing 2,500 contracts went up today, which seems like a lot for a stock that's 7 cents. Because I'm with you, HM. At this point, I don't know. Brian, would you ever buy a call for 3 to 5 cents that goes away in 3 months on a stock that's worth 7 cents when you could buy all the stock you want for 7 cents? And I think we talked before, but this is kind of an extreme case. What are your thoughts in general as well on just on trading options on these extremely cheap names like this?
Right. Nobody does. The only reason why you trade them is because you got a position in them, and you need to get out of them. So I do see a bunch of open interest. So there's a lot of people that are getting stuck in this underlying and trying to trade it and get out of it. And almost everything that I see is no bid. And the other thing about low price stocks, and you got to even watch, because back in the day in 2008 in this, and like companies like Ford, they became penny stocks, or at least dollar stocks, if you will. And what happens when you are short those option contracts, you have a lot of danger of just getting assigned on short puts in particular, also on short calls. And I actually did a few fancy trades around Ford because they just looked really nice in the options market, and I kind of got screwed up with a few assignments, and so you got to watch yourself on it. But the people that are probably trading this just in general are trying to get out. They're trying to find some salvation and get their positions off the books. But nobody would, in their right mind, just trade this as opposed to just buying the stock outright if they were bullish on HMNY. I mean, it is what it is.
Yeah, if they're sane, at least. I'm looking here. I can't even get analytics on it to come up on my platforms here, so I don't know where they're getting these quotes to trade off them, but I'm having a hard time even getting those. I'm guessing new series are not being listed at an aggressive pace on a 7 cent.
They got January's in here, 527 days. So this is going to be a nightmare for the quoting system for some time to come.
Yeah, those are probably trading more than the stock's worth.
Yeah,
on those Jans. There you go. That's a good theoretical thought question as well. Buy a Jan or buy the stock. One has an expiration date, one does not. Which would you rather have? Ling, question from Ling here. They're asking, I've heard some educators say that you should never hold out for the max profit in an option spread trade because that means you held on to it too long. Is this the case? Do you agree? Thanks, and enjoying the handbook. I think you mean the playbook there, Ling, but I don't think Brian takes too much umbrage at that. As long as you're reading the book, you're having fun with it. The title is immaterial there. But you're right. That is an interesting point. In fact, Brian, I think you kind of brought something similar like that up on your last episode of Options Playbook, where you were talking, I believe, about your favorite strategy of all time, the skip, strike, fly, and how if you hold that to getting 100%, you probably did something wrong. So it sounds like Ling is echoing that sentiment there, sir.
Yeah, and the biggest thing about all spreads, any type of spread, when you're buying one option and you're selling one option, and they're conflicting usually, right? Because you're usually on the same type. So I'm buying one call, selling a call. And if I buy a call, I want the market to go up. If I sell a call, I want the market to go down. So they fight each other. And trying to get that last few cents out of that short call, if you are correct on your forecast, is usually not worth the risk of the profit that you have on that trade. But the biggest thing when you start trading spreads is to realize that when you get to the short strike, you're not going to make the maximum on that trade right away. So you have to plan that into your numbers. And the more you trade them, the more you get used to that. And it's also a benefit on the downside. So if you are incorrect, you're also not going to lose as quickly on the downside because you have one option that is actually liking that the situation that the market is going against you. So there's good and there's bad to it, but most of the time, whenever you're putting on a trade, you set, this is what I'm willing to take on the risk on the downside, and this is what I'm looking for on the upside. And you need to get out when you get that. When it gets to that target forecast, wherever you think the market should be at, you just need to close the trade and go on. And usually, if you're making the maximum, you're staying in too long.
A good rule of thumb, I think, for a lot of options trading, people have this. I think part of this, Brian, problem is too is a lot of people learn options through the old expiration graphs, right? The P&L graphs, they show you here's the max profit at expiration, here's your max loss. They look at that and say, okay, I should be aiming for that. That's what I want. When in reality, some percentage they're in, 60, 70, maybe 80% if you're aggressive. That should be really your target goal. So I think a lot of that has to go back with the way we teach options, which is, of course, back. I've always said before, I have issues with those kind of, I get why people do it. It's kind of a stark contrast, max pain, max loss, that kind of thing. But still, I think it sets people up for maybe some expectations that don't serve them well in the long run when they're trading options. Let's see, we got time for one more, Mr. Brian. We're going to be generous to the folks today. We got so many questions. Keep them coming in. We love to hear from you guys here on the show. Let's wrap it up with this one, Brian, from Flyguy. I like that handle, Flyguy. Flyguy says, hey yourself, Flyguy. Hey, what do you guys do with your long calendar spreads? Do you close off the short leg if the stock doesn't move, then keep the long leg, or just close the whole spread out? This is a fascinating question. It kind of speaks to your use case for these spreads. If you're not familiar with calendars, long calendars, first off, you should read the Options Playbook. They're in there. Or the handbook, as I think it was Ling referred to it earlier. Whichever one, Options Playbook, Options Handbook, they all work. But Options Playbook is the only way to get to the URL, by the way. So if you want to go to the website for it, it's got to go to optionsplaybook.com. But long calendar means you're going to effectively buy, let's say in this scenario, a 1 month or 2 month out option. And at the money strike, let's say a call, and you're going to turn around and sell the 1 month out option on the same strike, call again. So you have effectively, that's calendar. Same strike, different expiration months. You start getting different strikes, you get into diagonals. That's a little bit of a different beast. But in general, a lot of people look at long calendars, buying the longer term one, selling the narrow term one, as a way to finance that longer term option. They think they put this spread on with the mindset that, hey, I think the stock's going to sit around, or the underlying is going to sit around for a while, so I don't mind being short that nearer term contract because it's probably just going to expire worthless, or maybe have a little bit of value, but not much. And then I get a much reduced shot on that long call later on. And that's certainly a use case. It's not really mine. I tend to look at it more as a spread, and then I'll probably maybe take it off or do some other things with that other leg. I don't really sit there and say, hey, I don't really put the calendar on as kind of like a freebie swing at the bat for the long leg, but I could see some of that use case. Brian, I know you're a fan of calendars and diagonals, all that fun stuff. Again, it's all broken down. Optionsplaybook.com for those of you out there who want to read more. Just get the book. You can get it on Amazon as well. But it's an interesting question here from Flyguy, Brian, because I think if you ask 10 different option people, you might get 10 different answers about why they use calendars. But what is your use case? Do you come in and do you use that nearer term short as a way to kind of finance a longer term position? Do you close the whole thing out? Do you maybe spread into something else? So what's your use case? What's your methodology for calendars?
Well, I guess I'll tell you my favorite calendar to do. And the one thing that I like about it is, first of all, when you're doing a long calendar, a lot of people have a misconception. They don't really understand that you are actually long volatility when you're doing a long calendar, which is the exact opposite of a butterfly. The profit and loss graph inside the option playbook looks very similar in that there's a peak right at the middle strike or at the strike price of the calendar or the middle strike of the butterfly. But the fact that you are long volatility in that type of trade is when I like to set up a calendar around earnings. I like to buy the month that contains the earnings or has an expiration that expires after their earnings report and sell the month that does not have earnings. And here's the rationale. When you do a long calendar, if you're correct on your forecast, your short option goes away and your long option sticks around, right? And so if you are long an option contract with the correct forecast, what do you want to happen to implied volatility? You hope it goes up on your option contract. So with that said, if I'm doing that type of trade and I get the move towards my strike price or it sticks around the middle strike price on a calendar, I like to just take the trade off because I was putting the trade on more as a volatility play than I was as a spread. Now, with that said, I have done more so diagonals where I'm trying to get a cheap call, as Mark was just talking about, or a cheap put if I want to be bearish on the downside. And the way that I like to do those trades is I like to, let's say I'm going into earnings. I think I specifically did one of these on Alphabet not that long ago going into earnings. And I like to sell that front month option with the same delta as the back month option contract. And my whole goal there is that if the market doesn't get to the strike price, and I'm usually doing them directional, no matter if I'm bullish or bearish, so I'm out of the money on either side. And if it gets to that strike price and the deltas are the same, I should be at least even on the trade and I would just get out. And if it doesn't get to the strike price, I let the front month expire worthless, and then that leaves me naked long, a long call or a long put. But I prefer to do that scenario. Like if I'm looking to just try to get into it on a little bit of a naked side and do it a cheap shot, if you will, maybe around earnings, or just because I'm bullish on the underlying, I like to do it more as a diagonal trade where I'm selling a near term, more at the money option contract and going a little bit further out of the money and hoping to pay for that further out of the money option contract. And a lot of times I'm looking to do it, for even or even a small credit if I can pull it off. But it's all about getting the same delta on the one that I'm selling versus the delta on the one that I'm buying, because I don't want a lot of short-term risk if the market does go to my strike right away.
Yeah, calendars are always an interesting one. I always kind of view them. I'd be curious if you agree, Brian. It seems to me like calendars are really where the rubber meets the road for a lot of options traders. I kind of view that as more like that's the 201 level stuff, some more advanced stuff. People understand, their verticals, they understand stuff in the same expiration month. They can get their heads around that. Once you start adding different expirations, things get a little bit wonky. Would you agree with that, Brian? That's kind of where people start to fall apart a little bit when it comes to options.
Yes, it's by far the hardest strategy to teach. And it just even goes to the scenario that I talked about. A lot of people that do long calendars don't really realize they want implied volatility to increase. It just sometimes can be counterintuitive, but you're going to end up long an option if you're correct on your forecast. Maybe
those people should spend some more time with the Greeks chapter of Options Playbook. What do you think, sir?
Oh, definitely. That always helps out.
Well, Brian, if there are people who want to send in questions to us, or maybe perhaps they want to read the old Options Playbook for themselves, where should they go? What should they do, sir?
Well, obviously, you can always go to optionsplaybook.com. That has all the information there. You can purchase it as you mentioned, it's on Amazon. But if you have any questions or whatever, you can actually just send them over to me. I have a email address just made up for Options Playbook Radio called theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. And I want to say thanks for listening, and I'm really glad, Mark, that you're able to join me or able to answer some of these questions. And we'll be back at the same time, same place next week. So Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.